Have you ever wondered why we don't just record investments in other companies at cost, but sometimes use the equity method instead? That's exactly what we'll cover today. By the end of this video, you'll understand what significant influence means, how to apply the equity method step by step, and the key differences between IFRS and ASPE. Before we jump in, don't forget to hit the like button and subscribe to Canada Accounting Insights. It helps us bring more CPA-friendly content straight to your screen. Let's start with the big picture. An associate is an entity over which an investor has significant influence but not control. That's the key word, influence. If you control another entity, usually over 50% of voting shares, that's a subsidiary, and you consolidate. If you're just holding passive shares without any influence, you use fair value through profit or loss or OCI. But in between lies the gray zone. 20% to 50% ownership generally indicates significant influence, and this is where the equity method comes in. But it's not just about percentages. Other factors matter. Having seats on the board of directors, participating in policy decisions, major transactions between the investor and investee, sharing management personnel, or providing essential technical information. Here's a simple case. Maple Inc. buys 18% of Oaklanted below the 20% guideline, but Maple also gets 2 out of 10 board seats and happens to be Oak's biggest customer, making up 25% of sales. Even with less than 20%, Maple clearly has influence. Under IFRS, Maple must apply the equity method. Now that we've defined what an associate is and when significant influence exists, let's move on to see how we record these investments on day one. Under IAS 28, investments in associates are initially recognized at cost. Journal entry is straightforward. Debit investment in associate, credit cash, or other consideration. For example, River Corp buys 30% of Stone Cowers for $342,000 cash. The entry is debit investment in Stone, $342,000. Credit cash, $342,000. What about transaction costs? IAS 28 doesn't spell it out directly, but in practice, they're usually capitalized, added to the investment account. Now that we've set up the investment at cost, the real magic of the equity method comes in the subsequent measurement phase. Let's see how that works. The equity method is sometimes called one-line consolidation. Why? Because instead of consolidating all assets and liabilities, you just update one line, investment in associate. Here's how it works. Add your share of net income equity income. Deduct your share of losses. Deduct dividends received, not as income, but as a reduction of the investment. Example continuation with River Corporation and Stone Company. Year 1. Stone earns $140,000 and pays $60,000 in dividends. River's 30% share of net income equals $42,000. Increases the investment. River's 30% share of dividends equals $18,000. Decreases the investment. Ending balance, $366,000. Year 2. Stone earns $180,000 and pays $70,000 in dividends. River's share equals $54,000 income, $21,000 dividends. Ending balance, $399,000. Year 3. Stone has a loss of $60,000 and pays $30,000 dividends. River's share equals $18,000 loss, $9,000 dividends. Ending balance, $372,000. You notice that dividends aren't recorded as revenue. Why? Because that would be double counting. You've already recognized your share of net income. All right, so far we've focused on IFRS, but what happens if you're reporting under ASPE? Let's compare. Here's where the standards diverge. Under IFRS IAS 28, equity method is mandatory when you have significant influence. Under ASPE, Section 3051, you have a choice. If the company is private, you can use equity method or cost method. If the shares are publicly traded, the choice is between equity method or fair value. Cost is not allowed. Let's revisit an example. Summit Inc. buys 22% of Breeze Corp. for $200,000 plus $7,500 in transaction costs. If Breeze is private, Summit can choose equity or cost. If Breeze is public, Summit must choose equity or fair value. If Summit picks cost method, dividends are recorded as income. If Summit picks equity method, dividends reduce the investment balance, and equity income is recognized. If Summit picks fair value, changes in market price go through the investment account with gains or losses recognized in income. With that comparison in mind, let's pull it all together into a quick recap of the main takeaways. Here are the essentials to remember. Significant influence equals generally 20% to 50% ownership plus other factors. Equity method equals initial recognition at cost, then adjust for share of income and dividends. Dividends reduce investment, they are not income. IFRS requires equity method. ASPE gives options depending on whether the company is private or public. Think of the equity method as telling a story. Your investment isn't just a static number. It moves with the success or struggles of the associate. And that's investments in associates in a nutshell. IFRS versus ASPE. If this helped clarify the equity method for you, don't forget to like this video and subscribe to Canada Accounting Insights for more exam-ready and real-world accounting lessons. In the next video, we'll dive deeper into the step-by-step in the equity method. We are going to talk about goodwill, bargain price, and more, so stay tuned.